This week we're going to look at the equity risk premium in the US and also in Australia, and then we'll go on and have a look at the monetary conditions index for Australia. Now the equity risk premium, as we've measured it here, is just a simple one stage where it looks at the dividend yield, adds a figure for growth, which is we use trend real GDP, average inflation over recent years of about 2%, and subtract the bond yield. We get a current reading in the US of around about 5%. You can see that in the chart in front of you. That compares with the average result over that period of around about 3.5%. So the equity risk premium would appear to be elevated at the moment, and I suppose that is giving some support to equities in this current environment. Now, we can relate the level of the equity risk premium to what is happening to growth, and growth relative to potential growth. So in this instance, I'm just going to add US output gap relative to GDP, obviously. Put that over in the right hand scale. So the gold line there on the chart is the US output gap. This is from the IMF, this particular data. And you can see that there's been a reasonably good relationship over a long period of time. As I mentioned, the equity risk premium sitting currently around about 5%. Now, a correction in the equity risk premium, all other things being equal, back to its longer-term average from 5% to around about 3.5%, of course, would involve a substantial re-rating of the US equity market and lead to quite significant gains. However, we think it's probably unrealistic to assume that this would occur in its own right, and we need to look at some alternative scenarios. Now, one of those scenarios is just basically the normalization scenario, and what this would involve would be the output gap returning back or closing over the period ahead, and as we said there, that would be consistent with an equity risk premium that also declines. So in an environment where the output gap narrowed or closed completely, a normalization scenario, you would expect bond yields to rise from their current levels, possibly back to the long-term average, which is somewhere around about 3.75 to 4%, and that would actually achieve the objective of bringing the equity risk premium back in line with its long-term average, a normalization of the output gap. Now, and as I said, it entails a rise in bond yields. Equity risk premium goes from 5 to 3.5, and the returns from equities in that scenario, although volatile, would generally reflect the lower earnings growth type result. A second scenario would be that of a low growth scenario. Now, in the equity risk premium models that are used at the moment, I mentioned at the outset, we're using a long-term trend real GDP growth rate of around about 3%. Now, just to put this into a bit of context, you can see here, the chart in front of you shows the purple line, which is real GDP going back to the 1930s, and there's a gold trend line. The trend rate of growth in GDP over that period has been actually over 3%. But what is interesting, as you can see, since the GFC, that has slowed quite considerably and continues to depart, although growing at a lesser rate than the very longer term number. So if we incorporate a lower GDP trend growth rate number, say 2% instead of 3%, then we quickly get the equity risk premium back in line with the long-term average. Now, we would argue that bond yields have already adjusted to the lower trend growth environment. It's that equity assumptions or longer-term earnings growth assumptions have not necessarily adjusted to that, and that would be quite a problematic scenario for equities. Now, in addition to that, if you had a reduced potential growth rate, then that would also indicate that the recovery in place at the moment would run up against capacity constraints somewhat sooner and potentially create some upside risk to both inflation and bond yields and the Fed funds rate a lot sooner than the market is currently anticipating. So in that environment, not only are you looking at a lower long-term growth number, you're also looking at a cyclical upturn in interest rates, which would tend to undermine equities even more. For Australia, you can see here now on the chart, Australia is the pink line. The equity risk premium currently sitting around about 7%, so a couple of percent higher than that of the US, and that's made up of the assumptions there is trend GDP growth of about 3.25, inflation 2.25, and dividend yield around about 4.2 compared to the bond yield of 3. So this gets you a risk premium of 7. The long-term average gold line has it at 5%. So Australia seems similar to the US, well above the long-term average at the present time. Finally, I want to finish up with just some brief comments on the Monetary Conditions Index for Australia. Chart in front of you looks at the Monetary Conditions Index using, and it's a narrow measure, using the real effective exchange rate relative to the past 20 or so years, or since inflation targeting began in 93, and also uses a real borrowing cost, and we've used mortgage rates in this instance as being probably the most important interest rate measure for Australia. So combining those two, we get a monetary conditions index which is now basically in line with its longer term or 22-year average after being very tight during 2011-2013 when the currency was quite high. You can see here we've gone in two legs over the past couple of years to take it back to a neutral. But what I would argue is that monetary conditions are not easy enough for Australia. While that may seem strange with the real mortgage rate down at 3% compared with a longer-term average of, a longer-term average of around about 5%, it's the currency that is really creating the problems. And if we were to throw into that the terms of trade, which is not included in this monetary conditions index, and the terms of trade have been declining, the currency is not keeping pace with that. So in a broader sense, conditions are even tighter than what this would suggest in Australia, meaning that the currency arguably has to fall further than the terms of trade over the next 6 to 12 months, and possibly interest rates to be cut further in order to generate what might be deemed to be easy or accommodative monetary conditions overall.